All right, let's dive into a real head-scratcher from the world of electric vehicles. We're talking about NIO. It's a company that is, by all accounts, selling cars like crazy, hitting all-time highs. And yet, its stock price seems to be stuck in reverse. So let's get into it and figure out this paradox.
This right here is the big question, isn't it? It's the puzzle that has everyone talking, from seasoned investors to EV fans. On the surface, it just doesn't add up. But as you're about to see, the real story is hiding just beneath those shiny sales numbers.
And here it is, in black and white. On the very same day, you get news that NIO's deliveries shot up nearly 55% compared to the year before. I mean, that's fantastic, right? But then you look at the market, and the stock actually dropped almost 4%. This is the exact disconnect we're here to understand.
Okay, so to figure this out, let's start by looking at the good stuff. We're going to build the case for the optimists, the bulls. Let's look at all the positive news that makes it seem like NIO is absolutely crushing it.
It all starts with this one massive number. In December of 2025, NIO delivered 48,135 cars. This wasn't just a pretty good month. It was by far their best month ever, a new record.
And that wasn't a fluke. That momentum just steamrolled through the entire fourth quarter. A jaw-dropping 71.7% increase in deliveries compared to the same time last year. You know, this isn't just growth, it's a sales explosion.
Now, this chart really puts that momentum into perspective for the whole year. You can just see the jump. They went from about 222,000 vehicles in 2024 to over 326,000 in 2025. That is a huge leap. It shows this isn't just one hot quarter, it's powerful, sustained expansion.
And of course, when you sell a record number of cars, you get record revenue. The company expected to rake in around $4.27 billion just from vehicle sales just in the fourth quarter. That gives you a sense of the massive financial scale we're talking about here.
And to top it all off, they've got a pretty strong tailwind. There are new government subsidies for electric vehicles that are expected to keep this growth engine firing on all cylinders well into 2026. So from every angle you look at it, the sales story is just fantastic.
Which, brings us right back to our paradox. If sales are through the roof and the future looks even better, what are we missing? Why isn't Wall Street throwing a party? Well, this is where we have to start digging a little deeper than the headlines.
Okay, let's flip the coin. It's time to look at the other side of the argument. This is the bear case, and it has nothing to do with how good the cars are. It's all about the cash. Specifically, it's about the staggering cost of all that incredible growth.
And here's where the story gets really complicated. Look at the gross margin, just under 10%. That means for every car NIO sells, they make a little bit of profit on just the raw materials and the factory labor. But that's not the real story. The operating margin is. Once you add in everything else, R&D, marketing, salaries, all of it, they are actually losing more than 33 cents for every single dollar of revenue. Simply put, they are spending way, way more than they make.
And the warning signs don't stop there. Take free cash flow. That's basically the hard cash a company has left over after paying all its bills to keep the lights on and expand. For NIO, that number is negative, and it's getting worse. On top of all that, even with record sales, they actually missed some of the sky-high expectations from investors, who were hoping for even crazier numbers.
So if you're feeling a bit confused by all this, don't worry. You're in good company. This clash between amazing sales and really troubling financials has the experts totally divided. I mean, Wall Street analysts are looking at the exact same data and coming to completely different conclusions. I mean, just look at this. You've got JPMorgan on one side super bullish, saying the stock is a buy and should be worth $8. But then you have Barclays on the other side extremely bearish, saying it's only worth $4. With the stock sitting around $5, that's a huge disagreement. It's a fundamental conflict over where this company is headed.
So how do we make sense of this? How can both of these stories be true at the same time? Well, the answer lies in one of the oldest tug-of-wars in business. It's a concept that really gets to the heart of the whole NIO paradox.
It all comes down to the battle between growth and profitability. See, a company can pour every dollar it has into growing as fast as humanly possible to grab market share and get customers in the door. Or it can focus on actually making a profit on the things it sells. This is a classic playbook, right? We saw it with Amazon for years, and even Tesla in its early days. You bet everything on dominating the market first and worry about profits later. NIO is deep in that growth-at-all-costs strategy, and investors are starting to get nervous about when or even if the profitability part of the plan will ever kick in.
So really, that's what it all boils down to. You've got two completely different stories being told about NIO at the exact same time. The growth story is a blockbuster, full of record sales, a growing market, and government support. But the profit story is, well, it's a horror movie, full of scary losses, cash burn, and a very uncertain road to ever making money. And right now, investors are placing their bets on which story they believe will win out in the end.
And that leaves us with the ultimate question. Is NIO just making a smart investment in its future, using subsidies as a bridge to get to eventual massive profitability? Or is this whole growth engine just running on fumes, burning through cash so fast that it might just run out of road? The answer to that is going to determine whether this paradox is just a bump in the road or a sign of a fundamental flaw.